gold nor silver can bankrupt. They cannot default in a world that is entering a default phase. So there's your shortage. And when you tell a human being that they can't have something, they want it even more. It ends up in a failure to deliver. It ends up with too many people saying, I want my silver, and that silver not being available. The problem with that is, as soon as that happens, that day or the next day, you'll see the same thing in gold. Then you'll see it inflating. Then you'll see it in platinum. The gold to silver ratio got as high as 120. Now it's what, 63, 64, something like that. Silver comes out of the ground at 9 or 10 to 1 versus gold. And for hundreds of years, it was discounted to 16 to 1.
And industry and perhaps institutional investors are buying these 1,000-ounce blocks of silver at a rate that cannot be maintained at the current demand. As money, it's got to be worth a lot more than that, which means, make it 2%, you've got to multiply it by 10, which is just $600 silver.
Gold and silver cannot go bankrupt, default, or be printed away. As the global system moves deeper into a debt-driven default phase, shortages don't begin with paper. They start with physical metal. When people are told they cannot have something tangible, demand accelerates, delivery failures appear, and stress spreads rapidly across markets. Holter and David Morgan point to a structural imbalance forming in silver. The gold-to-silver ratio recently surged above 120 before snapping back toward the low 60s, despite silver being mined at roughly 9 to 10 ounces per ounce of gold. For centuries, that ratio averaged near 16 to 1. Today, industrial users and institutions are absorbing 1,000-ounce commercial bars, overwhelming a derivatives-based pricing system that cannot sustain current demand. Silver represents just 0.2% of the global financial system. To reach even 2% monetary relevance implies a 10 times revaluation, pointing toward $600 silver. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The bottom line is gold nor silver can bankrupt. They cannot default in a world that is entering a default phase. Because we put too much debt on the books globally, the money does not exist to pay both the principal and the interest. So what have they done? What are they doing? They're printing, money supplies over time have exploded, and the explosion of the money supplies dilutes the value. So now you've got you have a circular, going down the drain. The more they print, the lower the value of the currencies, and thus the higher price, if you will. Gold and silver do nothing. It's the currencies that go up and down. And the currencies are devaluing greatly, and there's your price explosion. The shorts, I do not believe, understand that this has been going on for 50 years, or at least since 1976, when the COMEX started and they had the paper contracts. Understand that silver is an extremely small market. Even at today's prices, I think the total global production is only $40 or $50 billion a year, which is nothing in today's world. I don't believe that it was profit-oriented to begin with.
Mm-hmm.
The central banks colluded around the world to lease gold and have that gold sold into the market to suppress the price. The reason that was done is because gold is the anti-dollar, if you will. It's the anti-fiat. It's direct competition for fiat currencies. Now, if you suppress gold, you can't let silver skyrocket. So they suppress silver. But silver is easier to suppress because it's such a small market. And they got used to being able to smash the price, scare the speculators out, and then they made a profit. But overall, it was not profit motivated. It was simply suppression motivated, so that these governments, particularly the U.S. government, could borrow in unlimited quantities. If gold and silver are not going higher, that means the thermometer is not showing a fever. So if you break the thermometer, you can say there's no fever, gold bad, dollar good. Now the thermometer is breaking. The paper contracts, they sold way, way, way too many, and we're at the point now where people are standing for delivery. And guess what? The metal doesn't exist to supply all these contracts that have been sold short. And Now you're seeing price go higher and these banks are losing billions of dollars. It ends up in a failure to deliver. It ends up with too many people saying, I want my silver, and that silver not being available. The problem with that is as soon as that happens, that day or the next day, you'll see the same thing in gold. Then you'll see it in palladium. Then you'll see it in platinum. Then you'll see it in other futures contracts. People will think, well, wait a minute, have they oversold pork bellies? Have they oversold wheat? Have they oversold whatever. It will lead to a break in confidence. And once confidence breaks, then you've got a problem in the credit markets because credit runs on trust, runs on confidence. Nobody's going to lend. I mean, talk about an old story. Think about Wimpy on Popeye. I'll gladly pay you Tuesday for a hamburger today. If credit hiccups or if credit ceases, the entire world, everything you do, everything you touch runs on credit. The real economy runs on credit, and so does the financial world, the financial economy. So once this affects credit, then it's game over. You'll see markets close, and that's where the great taking will take over. They put these laws into effect. The ink is dry. They didn't do that just in case. They did it to use it. The gold to silver ratio got as high as 120. Now it's 63, 64, something like that. Silver comes out of the ground at 9 or 10 to 1 versus gold. And for hundreds of years, it was discounted to 16 to 1. The reason it was discounted 16 to 1 from 10 to 1 is that it took 10 times the amount of weight when you're moving either gold or silver. It took 10 times more silver versus gold to move the same amount of capital. So because it was more difficult to move silver, man discounted it to 16 to 1. Then along came COMEX in 1976. The suppression scheme started, and silver's much easier to suppress. It's been suppressed for the 50-year time frame, and now looks like it's beginning to unwind. I mean, I would not, if you've got silver and you're wanting to convert it to gold, I'd do it in tranches. I'd do it in 4 tranches. I'd probably do a quarter when we got the 50 to 1, a quarter at 40 to 1, a quarter at 30 to 1, and then the last tranche of what you want your final mix to look like. You do that final tranche based on your gut.
Silver is basically 65% industrial and maybe 20% monetary. What's the difference? Those two only add about 80 or 85. Well, the rest is jewelry and silverware. But in the big picture, we're in a dynamic that many of us have predicted over a very long time. And quite frankly, it's taken longer to get to this point than I expected. Nonetheless, here we are. And what does that mean? Where are we? Well, we are at a point where the derivatives market, the futures exchanges, both the COMEX and frankly, the LBMA, which is really an exchange association, but similar function. It basically does a lot of paper derivatives that work in the what's called forwards markets, which is similar to the futures exchange. So based on that, what we have is a situation where the physical commercial bar market, which is the derivatives basis, has taken precedence over all of the silver products, which means that industry and perhaps institutional investors are buying these 1,000-ounce blocks of silver at a rate that cannot be maintained at the current demand. Now, perhaps there's enough inventory to satisfy demand, but it's in the wrong place, which means that we saw these arbitrage opportunities that took hold between the LBMA and the COMEX. A lot flew from London over to New York based on fear of tariffs, became an arbitrage, so even more came over. And then the LBMA was held in a situation where they needed physical, they didn't have, so some more shipped back from New York and the LBMA. And really the one that's talked about a lot, but the least understood, and the reason it's least understood is it's opaque, we don't know all the dynamics, is this Shanghai Futures Exchange and the amount of physical that goes through that exchange. And from the few facts that I've been able to verify and ascertain, it seems as if that's actually the driver behind the big move. It could be that the Chinese, Asian market, someone in Hong Kong, could be in Dubai, just working through that exchange. Doesn't necessarily mean that location, just means that exchange has got such a demand, either for current need or perhaps future need, thinking, well, we want to stay in production with our, PV plant for the next 5 years. In order to do that, we need X amount of silver. I'm going to buy that amount of silver over the next, 6 months to a year, and I'm going to warehouse it myself. The other part is mispricing. I mean, for silver to have any significance in the monetary sphere, it's got to be astronomically priced from where it is now. I mean, if you look at the financial system as it stands right now, silver's probably 0.2% of the entire financial system. So as money, it's got to be worth a lot more than that, which means, to make it 2%, you've got to multiply it by 10, which is just $600 silver. And even there, would it be significant enough to have a monetary effect or not? Maybe possibly. So that's the other part of my thinking.
Gold and silver cannot default or go bankrupt. In a world sliding into a debt-driven default cycle, the real problem is not the metals, it is the currencies. Global debt has grown far beyond the ability to repay principal and interest, forcing continuous monetary expansion. As money supply explodes, purchasing power erodes, and prices rise as a reflection of currency weakness, not metal strength. Silver sits at the center of this stress. It is a tiny market, with annual global production measured in only tens of billions, yet it supports both industrial demand and monetary demand. Decades of paper suppression through futures and forwards distorted price discovery, but that mechanism is now cracking. Physical delivery is being demanded, inventories are in the wrong locations, and arbitrage between New York, London, and Asia is no longer smoothing the system. With silver representing barely 0.2% of the global financial system, a meaningful monetary role implies radically higher prices. Let's get back to the interview.
The gold-silver ratio from the 13th century up until about the 19th century, we saw the gold-silver ratio below 20. But the reason that is because it traded near what I call a natural ratio, how it came out of the ground, and they both serve the same function, money and money alone. So when we were on more of a silver standard, a bimetallic standard, it made sense that the natural ratio would be pretty much the ratio you would see in commerce. And that's what happened. Now, since we've had the industrial technological revolution for, 100 years or more, and especially now in the last, 15, 20 years, silver's become industrialized technologically to where, it is just a commodity and it is just needed for technology and nothing else, which isn't really true, as we already discussed. But nonetheless, I do think it skewed the ratio. So to go back to the monetary ratio, Ben, honestly, I don't see that. I don't rule it out. I've written about it as a possibility, but not a probability. But I think still the gold-silver ratio is too high. I'm thinking more of the mean of a 50 to 1 or perhaps 40 to 1, which is almost a double from here, meaning silver would outperform gold on a relative basis twice as much. I don't know. I don't see silver ever coming back into the monetary sphere with the new monetary system. However, I do see gold taking that role.
Yeah, gold is the money of kings, the money of governments, if you will, and silver is the money of the people. And I do think that, especially China, but the East views silver more from a monetary mindset than Westerners do. So I think silver, and I'm not saying that silver and gold are going to become currency. You're not going to ever see convertible paper monies that are convertible to gold and silver, because they've already figured out when they do that, it converts, and then their supplies are wiped out. But I do believe that you're going to see governments back currencies with gold and silver, but not be convertible. Will be ratio back 20%, 40%. I mean, I don't know what the number is going to be, but I do believe for a currency to be trusted, it has to have some sort of backing. And that's what the BRICS are doing. That's what the BRICS have been talking about, going on 6-7 years now. I think that's where we're headed, is toward a ratio-backed currency, and that backing will be gold and silver. China, unofficially but official reserves are at least 35,000 tons, and they say they've got 3,000 tons. I mean, they've done it. If you look at what's gone through Shanghai over the last 15 years, plus their production of 400 tons per year, they are so much they're so far above 3,000 tons of reserves, it's not even funny.
Speculative manias always leave clues near the end, and precious metals are no different. When gold price targets become headline material, mainstream media suddenly wants metal commentators back on air, and subscriber growth turns vertical. History suggests the cycle is maturing. Those signals don't negate the bull case. They warn that discipline matters as enthusiasm peaks. Underneath the noise, the structural story remains powerful. Years of supply deficits, shrinking above-ground inventories, and rising Eastern demand have exposed the limits of paper pricing. Silver's annual supply struggles to meet industrial and investment demand, while gold continues to absorb global distrust in sovereign debt and reserve assets. As physical markets replace paper promises, price becomes the only mechanism left to balance supply and demand. That transition is rarely smooth, but it is decisive. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.